Welcome to Opal STV. Today I'm in London together with Robert Page from SA2 Advisors. For a number of years, Robert worked as a discretionary trader, and he was actually one of the most profitable traders worldwide at shops like Credit Suisse or Lehman Brothers. He took his expertise in trading and built a quantitative, systematic global macro fund that, again, this year in 2013 has been ranking as one of the best performing global macro funds. So I'm curious, Robert, how did everything start in your career?
I started in this business in 1991 out of graduate school at Stanford and undergrad at Cornell. And at that time, Wall Street was hiring guys with engineering degrees, and they were going straight to interest rate derivative option desks. And that's where I started, right there, pricing and building models to do pricing and hedge risk in the US market in New York. And then from that experience, 91, 2, 3, that Lehman offered me a great opportunity to move to Japan. And really, they offered me the whole yen derivative book to trade that, and then I built that up for them into a very large business spanning 12 currencies. And it was a very interesting time to begin trading in Asia. I got and arrived in Japan the week that the JGB market began its collapse of 1994. And it really taught me a lot. My first week of trading, the market absolutely collapses. Were unforeseen events, and that was really my first kind of trial by fire, the first time running a large amount of risk.
Those were absolutely difficult conditions, yet at the same time, you were Lehman's most profitable trader worldwide. So what did you do?
One of the most interesting trades at that time, and one of the most profitable, were floors on yen interest rates. I remember in 1994, about October, November of 94, I remember buying 7-year floors struck at 3% on yen LIBOR. And so this is something that pays off if LIBOR goes below 3%. At that time, LIBOR was 2.5%, and in 6 months it was expected to be 3.25%. I remember buying those for 17 basis points up front. And of course then what transpired was in 95 we had the Kobe earthquake, and we had this massive rally and collapse of the Japanese stock market, a rally in the bond market. And that trade in particular paid off over 50 times the premium invested. So it was trades like that. There was an element of arbitrage trading at that time, which is, I think, arbitrage trading in the world before long-term capital. It's the idea that the model was wrong somehow, and certainly the model was a little bit wrong for floors. But, we also had things like, the sawtooth or discontinuous yield curves or other things that today wouldn't happen. But, those were all things as part of a developing market. And I guess what I took away from that is sometimes models can be wrong, and you really have to do your homework, and by extensive amount of research and work can you spot these opportunities.
What are some of the other things that you learned in the early days of derivatives trading while you were in Japan?
I remember in 96 I had a particularly good year, and the number 2 guy behind me in the firm, he was trading Sweden. And he's still a friend of mine to this day. I mean, Swedish rates, long bond rates, went from 11 to 6.5 in 96. And my friend Ben, he must have gone risk off and risk on a number of times during the year, all doing complicated derivative trades. And at the end of the year, he'd made $85 million, and the head of the Swedish government bond desk came over to him and said, Ben, if you had just bought 100 million Swedish long bonds at the beginning of the year and put it in a desk drawer, you'd have $85 million right now. And you didn't need to do all this work and high numbers of trades. And that was very telling to me. I think, and later on, when I moved to Credit Suisse, at Credit Suisse, they definitely had the appetite to run large risk, both in swaps and government bonds and government bond futures. And what I found about running large positions, and certainly, is you don't need to overtrade them. You just have to do extensive research and be really confident in your position, and that having done your homework allows you not to overtrade a good trade and just sit back and let the trade work itself out. Because if you've done your work, then you'll be the first or one of the early adopters of a trade. And then everybody who comes after will push your trade into profitability. And so that combination of don't overtrade and do extensive research has allowed me or taught me how to run significant positions in the macro space.
Tell me more about SA2 Advisors, your current firm.
Well, in SA2 Advisors, I partnered with Majed Zindani, who's our head of research. Majed equally has a 20-year career in research. He worked at Lehman Brothers and Merrill Lynch and JP Morgan. And before that, it was quite a high-power research at Cray and IBM research. He's a PhD in math. And Majed has some more equity experience as well than I had during my first, say, 16 years of trading. And so our starting point, our test case was really Japan, actually, again, was the Japanese equity market is really the poster child for why many models in equities don't work. A lot of people look at equities and say, well, equities, they should all be at some risk premium or some risk-free spread over a long term. There's a lot of literature on this. Also, Robert Shiller has his cyclically adjusted PEs. And Japan is a walking example why that doesn't work in Japan. I mean, it's a very interesting country in the regard that in the 50s and 60s they had 8 or 10% growth. Then in the 70s they transitioned from 8, 6 down to 4% growth, 80s 4 down to 3.5. By 95, switches off, 0 growth. And most models that say it goes back to some long-term average don't work in that type of paradigm shift. And it continues to this day. So our test case was Japan, to be able to find models that were much more responsive to that. And still looking forward, what do we think today? I mean, Japan still has challenges. The World Bank says the working age population is going to be 8.75% smaller 10 years from now. Another 10 years, it's going to be 9% smaller. So assuming that they do all the work, the working age population, how the economy cannot contract on a real basis, we think is pretty challenging. So Japan continues to provide, we think, insight into global markets. The interesting part of the early work that Majed and I did together was really this Japanese model. We developed a model for forecasting Japanese equity returns for the long term, given the challenges that are going on in that country. Now, we developed it for that market, and we've now taken it and applied it to about 40 or 50 countries. And we've applied it to the whole back page of all these countries in The Economist magazine. And so we took a model that was designed for a country with really declining growth, an Asian tiger from grace, but now we apply it to emerging economies or developed economies, and we find it still has very good predictive power, which for a model, we think it's a very good sign. I mean, it's the ultimate, say, out-of-sample test. I mean, it was designed for one market, but we've used it the same in all the countries. And then those long-term forecasts, we think are a consistent basis then for investing across all the markets. And this was our first beginning for the fundamental quantitative space, is this experience within Japanese equities applied to the world.
Tell me more about your fund's performance.
We started trading 17 months ago, and I think during this past 17 months, what has been interesting, the most important bet you could make, I think, in global macro is the asset class. So within global macro, you trade 4 asset classes. You trade equities, fixed income, foreign exchange, and commodities. And really getting that asset class choice right, we think, has been the most important thing in the last 17 months. Second was, say, getting the country right, what we like to do in global macro, look at country level risk. And finally, third, the instrument or strategy, the instruments you used to do it, was probably the third choice. And this is probably different in the last 17 months than at other times where country or instruments were overshadowing the asset class bet. So for us, in 2012, the return drivers were fixed income and equities in Singapore and equities in some equity risk in Northern Europe. And in 2013, the driver has been predominantly equities in Southern Europe, in particular very small positions that we had in Spain and in Italy. And in 2013, so far we're up over 16% with the fund trading for 9 months and 1 month of the managed account.
You mentioned Southern Europe, Italy and Spain. Now, you talked before, when in your Japanese experience, that you used to go into positions quite early. Was it the same here when you build your exposures to the Southern European countries?
That's a good question, Matthias. And I think when you trade off fundamentals, I mean, there's a number of challenges. I mean, one of the things is that you can typically be early into trades and you fall into something called a value trap. You know, I think we've learned that one of the ways out of that is not to oversize things and to be very careful. I mean, we've had a small amount of exposure to Spain for the whole 17 months, and Italy only entered our portfolio at the end of June 2013. But by being early in a small size, you don't need to have large positions to produce good returns. And that is why we like this marriage of fundamental and quantitative as a style. And that for us, that really is its own style. And I think it's important to spend a minute and look at that definition. You know, we position ourselves, or SA2 does, within a space called fundamental quantitative macro. And we try and bring together the best of 2 different disciplines that aren't necessarily brought together. You know, within the fundamental space, you know, we have a firm belief that you have to use fundamental macro and economic data to run value models to select your trades. So that's the best of the fundamental space. And then within the quantitative space, you know, you have to be systematic about your approach and be unemotional, and you do large amounts of testing and let the model really make the decisions. And so the 2 married together allow us to take fundamental positions in a quantitative way, and we try and make everything. So in the high 90s, 95 or 97 or 99% of the decisions, certainly all the day-to-day decisions, are made by our models. There are, of course, models made by humans, and you know, we have to be able to conceptualize it first to get it down and into the model. But really, this marriage of the 2 takes the emotion away for something that could be quite scary. I mean, to buy Southern Europe 18 months ago, or to hold it continuously during that time, it was a scary trade. And also to hold Italy through the whole Berlusconi scandal. These were interesting times to take and hold these positions. And I think one of the good things and the interesting things about our approach is that this quantitative and fundamental together also highlights broader macro themes that maybe only discretionary macro traders would talk about. This country's interesting or that country's interesting. And this quantitative fundamental approach allows us to make those same macro calls, but in an unemotional way.
So your model is to marry fundamental with quantitative trading. That's quite unique. Tell me more about how else you're different.
We found our approach works best with the equity market, and we have fundamental value models for that. Plus the fixed income market, we think we've built value models based on macro fundamentals. For the interest rate market, we think that's pretty unique rather than just drawing the lines through the dots. We're looking for what interest rates are way too high or way too low. And for the foreign exchange market, so those three asset classes we spend our time on, and we also then look at using these value models cross-asset relationships between the three. And frequently this involves views on country-level risk as well as micro things, the individual equities as well. What we don't do, which is also I think quite telling and a differentiator, is we not in the high frequency trading space. We don't do that. We're not trying to do hundreds of thousands of trades and win on 51% of them. We also don't do risk premia reversion type trades or historic return based things like risk parity. We also don't do strategies based on technical analysis or data mining. We don't do these types of strategies, and we don't use technical analysis to guide us in terms of pricing and entry. And finally, we also don't do securities that don't fit into value-based models, or which means that we don't do commodities or commodity strategies and certain other things that just don't seem to us to fit into the value models, or at least they haven't worked for us, so we just don't do them. And that the combination of all of these makes a quite different return from the rest of the space. We think that it's a differentiator, the things that we don't do as well as the things that we do, and the way that we try and...
So if you put yourself out there as fundamental and quantitative, and if I look at your competitors and your large competitors like AQR and Bridgewater also run risk parity strategies or have built their most significant model and the biggest funds on the risk parity model. Now you're saying you never done risk parity. Why is that? And how else do you differentiate yourself from those other players?
When you look at the space, we stayed away from those models for two reasons. There were two reasons why we didn't choose to go down the risk parity route. One is our view on interest rates. And this first point is perhaps the correction to risk parity. We fundamentally view that interest rates with this quantitative easing were too low. And when you have interest rates well below even a low nominal growth, you shouldn't be leveraging the Treasury market. So we didn't want to leverage Treasury risk or fixed income risk. That was the first reason why we stayed away from it. Was we think in a very low rate environment you have to stay away from leveraging the Treasury market. And that's really the premise of risk parity. You leverage the Treasuries up to the equity risk. But there's another reason as well. On the risk side, I think to take a product and then say that you don't believe in technical analysis or historics, and then to base the scaling of it based on volatility, you're still basing the risk number based on its performance. And to us that never sat right. So our risk measures are not based on historic performance. And because when you get to a low interest rate environment, we think you have to be very cautious of the downside risk. And that, for us, was another red flag to stay away from leveraging the treasuries and the interest rate market at this juncture.
So how do your risk models work then?
Certainly I should caveat this, that the risk models that we were discussing, say risk premia or risk parity type approaches, these are multi-asset approaches. And I think within that, there are 2 or 3 things that we did to control risk. Before we even got to our risk assessment, we developed a framework that would, if you go on fundamentals, we wanted to be buying cheap assets. And we think that's part of the primary risk control. So, is that you buy things at good valuations. Now, of course, valuation alone is not the only reason to buy something. You have to still have good growth potential or in a relatively short time frame. So, but the first element of risk is really buying cheaply. And so this fundamental analysis often gets us there. The second thing is we also look at return per, or expected return per risk. And we try and look at that. And our risk measure, we wanted a contrarian risk measure. So for both equities and fixed income, we've chosen a contrarian approach. And what's contrarian about it? Well, the higher the yield, the less risky we would say it is. So the lower a bond's price, the less risky we would say it is. And the higher the price and the lower the yield, the more risk we assign to it. So it's always trying to work in that framework and look cross-asset with the realization that bonds are at their most risky when they yield the absolute least. And so because of that, and we've built that into the framework, that contrarian element, we tend to move away from fixed income when it goes to extremes in overvaluation.